Good morning. The math ran last night. Here is what changed and how historically similar conditions have evolved. We are observing stagflation strong, with a confirmation score of 18 of 19 economic series aligned. That is strong. Overnight, equity volatility moved sharply higher. The VIX climbed 10.82% to 21.31, placing it at the 82nd percentile of its 2-year range. Fear and greed reads 37.7, firmly in fear. Futures opened lower across all 3 major indices, and crude oil spiked 7.64% on geopolitical tension. Historically, similar configurations of high volatility paired with stagflationary pressure have coincided with either sustained risk-off behavior or the formation of support bases that extended 3 to 6 weeks, depending on inflation messaging and central bank commentary in that particular environment. We are tracking 3 primary signals. The first is high-yield credit spreads, BAM 0 a 0 HIM 2, at green momentum, defined as trading above the 60th percentile of its 12-month distribution. In 14 of 18 historical instances, when high-yield spreads carried this strength within stagflation strong, credit outperformed equity volatility over the subsequent 4-week window. The second signal is core inflation, CPIL-FESL, also green momentum, positioned above the 65th percentile of its 3-year monthly acceleration distribution. In 11 of 13 instances, when this signal aligned green during stagflationary regimes, central bank communication shifted hawkish within 2 to 3 weeks. The third signal is payroll growth, PAYMs, showing red momentum, monthly changes below the 40th percentile of trailing 2-year distribution. In 9 of 12 instances, when employment momentum turned red while the regime remained stagflation, initial jobless claims ICSA, also red at the 35th percentile, accelerated within 5 to 8 weeks. These are sample-bound observations only. The regime is stagflation strong. 18 of 19 series are aligned. Historically, over 3-month windows, this configuration has persisted in 52% of 11 observed instances. The most common transition has been movement toward acceleration, observed in 28% of instances. Contraction transitions occurred in 19% of the sample. These are historical mathematical frequencies that describe what the data captured in prior regimes. They are not predictions of what happens next. We have 2 conditional triggers to monitor. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive trading sessions. Historically, the inflation composite showed acceleration in 9 of 11 similar instances, a pattern tied to how yield levels have previously aligned with pricing behavior. If fear and greed drops below 15 and holds for 5 consecutive sessions, the confirmation score deteriorated in 7 of 9 historical instances. In those cases, a regime watch flag would be formally triggered, lowering our confidence level. These are conditional observations only, not forecasts, not recommendations. The math identified conditions across multiple symbols this week. That pattern exists. But that is a different conversation. Atlas is our educational engine that surfaces these historical mathematical configurations so serious investors can see how the environment has behaved in the past. It is designed for learning and context, not for making anyone's decisions. These are historical mathematical observations, not predictions and not advice. Given Analytics is not a registered investment advisor. Hypothetical results may vary from actual results. Market conditions can change at any time. May, potential, educational. This is Given Analytics. GivenAnalytics.com.